In Chapter 12, we will be discussing intangible assets. The learning objectives are explain the accounting for intangible assets, including initial valuation, amortization, and impairment. We'll identify and explain the accounting issues related to research and development, disclosures that need to be made related to intangibles, look at the specific accounting treatment for identifiable intangibles such as trademarks, trade names, copyrights, franchises, patents, and computer software costs. And then we'll account for unidentifiable intangibles, including internally developed and purchased goodwill. So where's the value? Even though intangible assets do not have physical or financial nature, they can create an enormous value for companies. So remember, that's an asset we can't see or touch. World Bank estimates that intangibles are not only the single most important component of wealth, but the fastest growing one as well. So intangible assets do not have physical or financial nature, but do have value based on the rights and privileges they convey to the company that owns and uses them. They generally have a higher degree of uncertainty regarding their future economic benefit, due in large part to their intangible nature. So it's harder to separate and sell relative to like a car, a tangible asset, or a building. Now, intangible assets that are externally acquired are purchased from others, either in a separate transaction or as part of a business acquisition. Purchased intangible assets are capitalized or debited to an asset account at their cost to obtain and prepared for use, very similar to a plant asset. Those that are internally developed, so they're created within the company. So there's stuff happening to create a patent. There's an invention occurring. As you're doing your research and development, basically, and you're developing, all the costs associated with that are expensed because the future economic benefit associated with them are difficult to measure. You're not even sure if you're going to have something at the end. And the costs incurred to develop internally developed intangible assets are difficult to measure separately from your normal ongoing operation costs of the business. Excuse me. So, identifiable intangible assets are intangible assets that are separated from the company and sold, transferred, licensed, rented, or exchanged. Some examples of these are trademarks and trade names, because you have a legal contract with them. You get a trademark from the federal government, I believe. Might be state. Patents, same deal again, from the U.S. Patent Office to protect an invention. Trademarks protect a name or a symbol. Copyrights protect artistic creations. Franchise rights gives you the ability to use a business model. Customer lists and relationships that are purchased or created. Unidentified intangible assets cannot be separated from the entity and sold, transferred, licensed, rented, or exchanged. The primary unidentified intangible asset is goodwill. And we're going to be talking about goodwill. It's really the most intangible of intangible assets. It's very hard to determine, and it's a lot of different factors. Now, when you purchase an intangible asset, those that are purchased from others, like a trademark or a copyright or a customer list, either in a separate transaction or as part of an overall business acquisition. They're capitalized at their cost to obtain the asset and prepared for use. Internally developed intangible assets are generally expensed. We talked about this. Internally developed, you just expense the amounts towards working on creating a patent or a copyright or an artistic work, an invention, as they occur. The costs incurred to develop internally generated intangible assets are difficult to measure. We talked about that. So here's a great flow chart. When you purchase an intangible asset, if it's identifiable, you capitalize it as an asset. You then determine, does it have a finite life? Does it have a life, or does it last forever? Indefinite. If it has a finite life, we actually expense it over its useful life. Just like we depreciate a plant asset over its useful life, we expense or amortize a finite life intangible asset. If it has an indefinite life, we always review it for impairment each year. If it's an unidentifiable intangible, such as Goodwill, we capitalize it and we review it for impairment each year. So if there's a loss due to impairment, we would record that as a decrease in value. Internally developed. If they're identifiable, we only capitalize certain costs, and they're usually costs we have to pay to a third party, like legal fees. Finite life, that's amortized. Indefinite life, just like before, you review for impairment. Research and development costs, expense. Unidentifiable intangible assets, internally developed, expense. So that's a great chart to have available to you, so you remember, what do I do with that and this one. So amortization is the expensing of the cost of an intangible asset in a systematic and rational manner. It's the same as depreciation. It's just depreciation is the expensing. That's what we refer to the expense account for plant assets, property, plants, and equipment, where amortization is just the expense, a name for expensing intangible assets that have a useful life. An impairment of an intangible asset occurs when the fair value of the intangible asset is less than its carrying value. Intangible assets are separated into two categories to determine whether they are amortized and how they are reviewed for impairment. And the two categories are intangible assets with a limited life and intangible assets with an indefinite life. So if you have an intangible asset with a finite life, a limited life, we expense it over its useful life. So what you would do is estimate the useful future life of the intangible asset by how long you legally could use it, contractually, technologically. The expected use of the intangible asset will help you define its life. The useful life of a related asset. A legal, regulatory, or contractual provision that enable renewal or extensions of the intangible asset's life without substantial economic cost. So you got to take all these factors into account. Effects of obsolescence, demand, competition, and other economic factors on that intangible's life. How much maintenance is required to obtain the expected future cash flows from that intangible asset? So all of these items are taken into account when determining the life of an intangible asset. Here's an example. Schultz Company purchased a patent for $85,000, amortizes it, expenses it using straight line method over 10 years with no expected residual value. How do we expense it? Straight line. Take the $85,000 cost divided by 10 years. First, when you purchase it, they will debit patent, which is an intangible asset, credit cash. First year's amortization, assuming they buy it as of the beginning of the year, would be $85,000 divided by 10 years, or $8,500. You have a choice when recording amortization expense. You will definitely debit amortization expense for the $8,500, but you have a choice with what you credit. You could either credit the patent asset account directly or set up a contra account called accumulated amortization patent, just like accumulated depreciation. The book value then of this patent would be the $85,000 minus $8,500, or $76,500. GAAP requires that a company review its intangible assets to see if they lost value. Is there an impairment? So there's a testing of intangible assets with a finite life that's similar or pretty much the same as plant assets. It's 2 steps. First is recoverability tests. What we do is we determine how much cash we expect to get from using this intangible asset. We just determine how much cash each year we're going to get, minus cash we have to pay out for it, over the life that remains. We then add that up and compare it to the asset's book value. If the cash flow amount is less than the book value, you have an impairment. To measure the loss, you compare the asset's book value to the asset's fair value, and the difference is the loss. Here's an example. When the patent from Schultz has a book value of $68,000, Schultz estimates that the future cash flow from this patent is only $40,000. The present value of the expected future cash flows is $25,000. Now, first test. Is there a recoverability test? The cash flows are less than the book value, so there is an impairment. What's the impairment? Well, they don't tell us fair value, and absent fair value, we just discount to present value those future cash flows. So they did that. So the present value of that $40,000, what's it worth today, is $25,000. So that is considered the asset's fair value. So there's a loss on impairment of $43,000 we would debit, and we would credit the asset patent for $43,000. And then we would use the remaining $25,000 as the new book value or amount to amortize of that patent over the remaining life. And that's what I'm talking about there. An intangible asset, though, with an indefinite life isn't expensed, but is reviewed for impairment, and it's pretty much a one-step process. An intangible asset with an indefinite life is impaired when its fair value is less than its book value. So you're not doing anything with cash flows because you really can't. It's an indefinite life. So Norton Company purchased a trademark 2 years ago for $60,000. Norton considered the trademark to have an indefinite life, so no amortization, so it still has a carrying value of $60,000. At the end of the year, they determined the fair value of it is $20,000. So there's a $40,000 loss on impairment that they'll debit and credit the trademark account for $40,000. So now it will have a value of $20,000 on the balance sheet. Oops. Next, the impairment loss then is a component of income from continuing operations on the income statement, no matter what, if it's a finite life or an indefinite life asset. So when you have an impairment loss, you record it as other gains and losses before discontinued operations. So in the continuing operations section on the income statement. And then the fair value, the new fair value, which is lower than the cost, is what is reported on the balance sheet for that intangible asset. Subsequently, the company must compare fair value with this new carrying value to determine if additional impairment has occurred. Okay, so that takes us pretty far. Pardon me. I'm just browsing through your book a little bit here. There we go. Okay. So that is all the intangibles that could be separately identified. They either have a finite life or an indefinite life, and how we handle them. What if we have goodwill? What is goodwill? Goodwill is defined and measured as the excess of the purchase price, so what somebody pays over the fair value of the identifiable net assets of the company, meaning the assets on the balance sheet. So they say, what did they pay for them? What are they worth? Not what's the book value on the balance sheet. What are the assets on the balance sheet worth minus liabilities? That if you pay more, so if a company pays more for those net assets The difference is called goodwill. Now, it's only recognized when one company purchases another company. That's when goodwill would happen. Before I go into research and development, goodwill, I like to look at it as all these really intangible things that aren't separately identified, but together produce a value that we call goodwill. So if you're sitting there thinking, why would somebody pay more than what the assets and liabilities are worth? Well, pick a company like Heinz Ketchup. Okay. Let's say Heinz Ketchup assets are worth $100,000. They're net assets. That's how much. If you sold all the net assets and paid off or sold all the assets, paid off all the liabilities, you would have $100,000 in cash left over. That's what that's saying. That's the fair value. But somebody comes in and pays $150,000 for it. Why would they do that? Well, just by the nature of the company, you hear Heinz, that's an identifiable name. It has a customer base, a large share of the ketchup market. It has generations of customers. They don't have to do advertising. They probably have a great management team. All of these things is what you just paid $50,000 more for. Really intangible things that have no value on the balance sheet. That's goodwill. Somebody just put a value to it, whoever was purchasing Heinz Ketchup. Research and development costs. Remember, research is the planned search or critical investigation aimed at discovering something new and hopefully will be useful in developing or improving a product or process, or significantly improving an existing one. Development is translating that research into a plan or design for a new product or process, or for significantly improving an existing product or process. So that's our definition of each. GAAP requires we expense them as they occur. So here are some examples of activities included in research and development. Laboratory research aimed at discovering a new knowledge. Searching for applications of new research findings or of other knowledge. So you found something. What can I do with that now? Conceptual formulation and design of possible product or process alternatives. Testing and search for or evaluation of product or process alternatives. Modifying a design of a product or process. Designing, constructing, and testing pre-production prototypes and models. Design of tools, jigs, molds, and dies involving new technology. So you guys could read this. So this is truly where we're at, where we're trying to find something new and then plan how to create it. Excluded from research and development. Engineering follow-through in the early phase of commercial production. That is not considered development. Quality control during commercial production. No. Troubleshooting in connections with breakdowns during production. No. Routine ongoing efforts to refine, enrich, or otherwise improve an existing product. So routine, that's our key word there. Adaptation of an existing capability to a particular requirement or customer need. That is not research and development. Seasonal or other periodic design changes to existing products. Routine design of tools, jigs, molds, and dies. So you're always doing it. You know, you're doing it every 3 months or something just to routinely look at these. That's the key. Is this something normal, part of the normal production process? And if it is, it's not research and development. So here's an example. Kent Company incurred and paid the following costs for research and development. Material used from inventory, wages and salaries, allocation of general and administrative costs, depreciation of the building and housing, multiple R&D activities, machine purchase for R&D products, so a total of $215. So if the machine cannot be used for any other purpose but research and development, here's how Kent would record this. They would credit cash for $140,000. The material used from inventory, okay. I'm sorry, the wages and salaries, the machine purchase for R&D projects, and the allocation of general and administrative costs. They would credit inventory for the amount in inventory that they used, and they would credit accumulated depreciation for the building and housing multiple R&D activities. Now, if it said there was no alternative use for that, they would have credited cash. Okay, but because, or not cash, but something else, because this is just saying, okay, depreciation. What is this? Research and development expense. So add them up, 215,000, and you would credit those accounts accordingly. Ah, there we go. Why didn't I keep going, huh? All right. So the two accounts, 90,000 and 20,000, you would debit research and development credit cash for those two. Allocation of your, depreciation of the building would be credited to accumulated depreciation building. The machine purchase for R&D projects, assuming this machine is going to be used over 5 years, and that's the assumption we're making here, you would debit the machine account, credit cash, of course, and then debit research and development for the depreciation, credit accumulated depreciation machinery for the 6,000. So the point of this is that if it's not for an alternative use, you expense it basically to research and development. But if it is, you only expense the depreciation portion. So if it could be used for an alternative use, just like the building. In process research and development, when a company that is performing R&D is acquired by another company, we call that the acquiring company must allocate a portion of the purchase price to the research and development activities, an intangible asset called in process research and development. When a company that is performing, initially capitalized at fair value and treated as an intangible asset with an indefinite life until that R&D activities are completed or abandoned. Then you decide. In-process R&D is expensed immediately if the project is abandoned. Otherwise accounted for either a finite life or indefinite life asset depending on its nature. Another type of, quote, intangible asset are startup costs. These are costs incurred for one-time activities that are related to opening a new facility or commencing a new operation. Excuse me. Introducing a new product or service. Conducting business in a new territory. Initiating a new process in an existing facility. Startup costs include organization costs such as legal fees, stock certificate costs, underwriting fees, and accounting fees. GAAP requires these be expensed as incurred, so there's no asset created by these types of costs. Okay, so how are intangible assets disclosed? Well, at the end of each period, a company presents a balance sheet. It should disclose intangible assets that are amortized, the total cost of them, the accumulated amortization, and estimated amortization expense for the next 5 years. For intangible assets that are non-amortized, the cost of each major class of intangible asset, the total of all identifiable intangible assets as a separate line item on the balance sheet, and for any intangible asset impairment other than goodwill, facts leading to the impairment, the amount of the impairment loss, the method of determining the fair value of the intangible asset, as well as any impairment losses should be included in income from continuing operations. At the end of each period, when a company presents a balance sheet, it should disclose for goodwill the amount of goodwill acquired, losses due to impairment, and show the loss as a separate item in continuing operations. If intangible assets are acquired during the period, GAAP requires the cost to be disclosed, residual value, and the weighted average amortization, and cost of any research and development acquired and written off when it's included in the income statement. So on pages 1212 and 1213, there is an example of a company's information on intangible assets. Identifiable intangible assets can be classified into 5 basic categories. So we're just looking at the different categories these can fall into: marketing, customers, artistic works, contracts, technology. Marketing-related intangible assets are resources used to promote or market a company's product or services. Some common examples: trademark or trade name, a word, name, phrase, or symbol that identifies the source of a product and distinguishes it from the products or of other companies. So like Under Armour, that's a distinct symbol. That's a trademarked symbol. Registration of the trademark or trade name is done with the U.S. Patent and Trademark Office. There, my question answered. Establishes a right to exclusive use for 10 years. It's renewable indefinitely, though. Internet domain names are names used to identify a particular internet address. Customer related. They're arising from the relationship between a company and its customers, such as customer lists, order production backlogs, and customer relationships. If these assets are developed internally, they are expensed as created. However, if you purchase them from another company, are included as part of a business combination, the amount of the purchase is a separate identifiable intangible asset. Customer-related intangibles are generally considered to have a limited life and are amortized. Artistic. These are a result of creation, the right to reproduce, copy, or perform artistic works. It is granted by the federal government that gives the owner the exclusive right to publish, sell, or otherwise control literary or artistic products for the life of the author plus 70 years. The cost of acquiring and successfully defending a copyright is capitalized. So if you have to pay a lawyer to acquire or to successfully defend your copyright, if you lose, no, you have to successfully defend it. Those legal fees are added as a cost of the copyright. Under U.S. GAAP, increases in the market value of intangible assets are not recognized in the financial statements. So increases, no. Contract-based intangibles represent the value of rights arising from a contractual agreement, such as a franchise agreement, where you are allowed to use a core business idea or model as your own. Licensing and royalty agreements. For instance, Hershey has a licensing agreement with Nestle in the Nestle Company. Nestle Company is actually the ones who own the recipe for the Kit Kat bar. They don't call it the Kit Kat bar in Europe, but they make that product in Europe. Hershey makes it here in the United States. They have a licensing agreement to do that. So they paid Nestle. Nestle gave them the right to use a licensing agreement to use that recipe. Construction permits, broadcast rights, use rights, like using music. Franchises, there we go. For a fee, the franchisor gives the franchisee the right to perform certain functions or sell certain products or services, like McDonald's. We capitalize the costs to acquire the franchise or license, but it expenses any continuing fees that may have to be paid on top of that. Technology-based are assets that represent technological advances and provide economic benefits to companies. A patent is a technology-based intangible, exclusive right granted by the federal government, giving the owner control of the manufacture, sale, or other use of the invention. It's granted for 20 years from the date of filing, and it cannot be renewed because it has a finite life. And software development is also included. Software that is to be sold, licensed, or leased to third parties include the cost of designing, the cost of coding, testing, are all included in software development costs. GAAP requires these costs be treated as R&D until technological feasibility of the product is established. That is established the date the company completes a detailed program design, or in its absence, when it completes a working model of a product. After this date, a company capitalizes all software development costs related to the product until it is available for general release to customers. So there's a little flow chart there. So that technological feasibility is the key date. It's expense, any amounts, expenditures are expensed up to that point. After that, they could be capitalized until general release, and then they're expensed again. The costs incurred in the preliminary stage of developing internal use computer software are expensed as incurred. Once that preliminary stage is completed and management agrees to fund the development of the software, the company capitalizes the software costs. Here's an example. Verlin develops computer video games for sale. A new development product reached a technological feasibility at the end of June, and the project was available for release to customers in January 2017. Development costs incurred prior to June were $1.6 million. From July 1 to December 31st were $1.2. So how do we account for those? Revenues in 2017 from the sale were $4 million, and the company anticipates another $12 million in revenue. The economic life of the software is 3 years. First of all, the cost before the feasibility date would be expensed. The cost from the feasibility date, so they would be expensed. The cost from the feasibility date till January 1, when they started selling it, would be capitalized as an asset, $1.2 million. Now, the amortization expense is the greater of. Two ways of doing this. The percent of revenue method, where we take the annual depreciation. The amount of revenue earned this year over all the revenue they expect to earn. It earned $4 million this year. It is expected to earn an additional 12, so $16 million. How much that percentage of the software cost would be expensed, or $300,000. The other method is straight line. So you take the greater of the two. 1.2 million divided by 3 years. So you would debit amortization expense, credit the software development costs, $400,000. Costs incurred in the preliminary stage are expensed, and we went over this a couple times already, so you could read through it. Goodwill. Remember, we said goodwill is an unidentified intangible asset with an indefinite life that is only recognized when one company purchases another company. Where does it result from? It's when the purchase price is above the fair value of the identifiable net assets. Internally developed goodwill is distinguished from other identifiable intangible assets by two characteristics. It is not separated from other assets of a company, and measuring the value of it is beyond difficult. Because everybody thinks their company's great and has all this extra stuff in it. The costs associated with internally developed assets are expensed as incurred. It just keeps everybody honest. How do you determine how much it costs and be able to call it an asset? So we just expense them. So goodwill is purchased. That's the only time you're going to see it on a balance sheet. It's the difference between the purchase price of the acquired company and the fair value of the identifiable net assets. 4 factors account for the difference in the value as a whole and the book value. Many assets are listed on the balance sheet, not a fair value. That's true. They're listed at book value. Identifiable intangible assets may be unrecorded or undervalued. They're not the same as market. Unidentifiable intangible assets may exist, but they're not even on the balance sheet. The acquirer may just pay too much. So those are some reasons why that would occur. Sarah Company acquires Trevor Company and purchases its net assets for $790,000. Now they show you book value there, but they also show you fair value, and fair value is what we're focused on. The fair value of the identifiable net assets is $390,000. That's all Sarah Company should have paid for Trevor, but they paid $790,000. So they paid $400,000 more than the fair value of the identifiable net assets. So the goodwill here, $400,000. The journal entry then for Sarah to record the purchase of Trevor, they would debit each asset, credit the liability for the fair value, credit cash for the $790,000 they paid. And then Sarah would have on their books an asset called goodwill for $400,000. Now, goodwill has an indefinite life, so it has to be tested for impairment. Impairment would exist if macroeconomic situations such as just deterioration in economic conditions or industry and market considerations deteriorate, cost factors such as increases in raw materials, labor, or other costs in the industry, a decline in financial performance of the company could affect goodwill, what somebody values beyond a fair value of the company. Changes in management. Maybe they had a really good management team and they all left. An expectation that a reporting unit may be sold. So because goodwill is an unidentifiable intangible asset that cannot be separated, the goodwill must be assigned to a reporting unit within the company. A reporting unit is an operating segment or component with discrete financial information and is available and regularly reviewed by management. It's tested for impairment within this reporting unit. If a qualitative assessment indicates that it's more than likely that the fair value of the reporting unit is less than its carrying value, the company performs a two-step quantitative impairment test. The first thing they do, determine if an impairment has occurred by comparing fair value of the reporting unit with its book value, including goodwill. Measure and recognize an impairment loss for the amount by which the implied fair value of the goodwill is less than its carrying value. So you have to determine, well, if we sold the company today, what would have been the amount of goodwill that would have been paid? If that's less than carrying value, you have an impairment. So if the fair value of the reporting unit is less than book value, the second step must be performed to measure the amount of the impairment loss. Let's look at an example, because we could read it all day long, but an example will really make this come home. Kent Company purchased Devon Company as a subsidiary several years ago. Devon is considered a reporting unit of Kent. Kent needs to perform the two-step impairment test. Kent compares Devon's $3 million fair value to its $3.6 million book value. Step 1. The fair value is less than the book value and impairment loss is indicated. So let's go to the second step. Kent then determines whether it needs to recognize an actual loss. So the first step just indicates, hey, you may have an impairment loss. The second step is where we determine the amount. Here's what we do. We determine the implied goodwill. How do we do that? Take the fair value of Devon overall, which is $3 million. Subtract that from the fair value of Devon's identifiable net assets, which is 2.7. So somebody's only willing to pay $3 million for a company worth 2.7. So the amount of goodwill that would result if it was sold today would be $300,000. What do we have it on our books for? $400,000. So there is considered to be an impairment loss here of $100,000. We write down the goodwill by crediting it for $100,000, and we debit impairment loss on goodwill, $100,000. Okay, so sometimes the opposite happens. It is possible that the cash paid for the company is actually less than the fair value. When that happens, you don't have negative goodwill. You have what we call a bargain purchase. So you have a company selling their, a company is being sold. The fair value of their net assets is $300,000. The company buying pays $275,000. Well, they just paid less than what the company's worth. So they got a deal. While such a situation isn't common, it may occur. So if such a bargain purchase occurs, you don't credit goodwill. It's not a negative goodwill. You actually record a gain. Okay, it's a gain on bargain purchase. So you would debit your assets, credit the liabilities you purchased, and you would credit gain on bargain purchase, and then of course cash if you paid cash.